We've seen how the S&P retains Indonesia's investment grade and negative outlook amidst of the mass vaccination going on in the country. So what's the reason behind that affirmation?
Sure, absolutely. So we did affirm the rating at BBB flat with a negative outlook. The affirmation says a few things, right? One is that, of course, the Indonesian economy is stabilizing following a difficult hit from the pandemic in 2020. We're expecting real GDP growth this year of 4.5%, followed by growth of around 5.4 or 5.5% next year. This will allow over time, in our opinion, the government's fiscal metrics also to stabilize. Right now, we have much higher fiscal deficits than Indonesia has customarily run over the past 20 years, looking at a fiscal deficit of around 5.7% of GDP this year. But if growth picks up over the next couple of years, then the government should be able to begin to pare that down. The same thing holds true for the debt stock. While this has risen and put additional pressure on Indonesia's credit metrics, at the same time, it will probably stabilize, in our opinion, around 40% of GDP on a net basis. And in the outer years, which is to say 2023, 2024, begin to come down gradually, in our opinion. But of course, the negative outlook on the ratings suggests that there are still significant risks that remain to this outlook. Of course, the Indonesian government's revenue last year fell pretty dramatically, and it will take some time, we think, for that to recover. In the interim, that means that the government's going to be paying more interest on its debt, its higher debt stock relative to its revenues. At the same time, also, the external metrics of the economy have worsened, in our opinion, in the context of the pandemic. And this is mostly because the current account receipts, the exports of goods and services in particular from the economy, have come down with the weaker global trade outlook. So we will be watching closely to see just how quickly this is able to recover over the next couple of years as well.
Okay, next question, Andrew. We've seen how our debt soared to a never-before-seen level in 2021 due to the pandemic. So what are the fiscal and also external risks that still need to be concerned by the Indonesian government in your point of view?
Sure, thanks. So first off, with regard to the debt stock, absolutely. For a long time, the Indonesian government maintained its debt stock on a net basis below 30% of GDP. This is really quite prudent, and it was a strength of the sovereign credit ratings for a long time as well. This went hand in hand with low fiscal deficits. What we observed in Indonesia for essentially 20 years after the Asian financial crisis were fiscal deficits that were below 3% of GDP per year, and some years even below 2% of GDP. In the context of the pandemic, it hasn't been possible for the government to run such tight fiscal settings. So last year, of course, we had a fiscal deficit slightly above 6% of GDP, much higher than what Indonesia's track record has been over the long term. And this year, again, it's going to be high as well, as the government hopes to foster that economic stabilization and hopefully recovery into 2022. If the economy does not recover at the pace and scale that we are expecting over this period of time, then this could put additional pressure on those fiscal settings. It could mean that fiscal deficits are higher for longer. A fiscal deficit above 4% of GDP on a sustained basis, leading to a change in net general government debt also above 4% of GDP on a sustained basis, would be indications of further downward pressure on the credit rating. Now, with regard to the external settings, what we saw last year again is that the exports from the economy, especially of goods and services, fell quite dramatically in the midst of the pandemic. And when we compare Indonesia's external debt stock, which is fairly high, against its current account receipts on an annual basis, this position worsened for the economy. It's still somewhat weaker today than it was prior to the pandemic. So what we will have to see is a good and healthy trade recovery in the global economy, and also demand for Indonesia's exports by its trade partners, such that those current account receipts can rise sufficiently over the next 2 or 3 years. so that this position can heal and improve back to essentially where it was prior to the pandemic. If the global trade recovery is weaker than expected, or if exports from Indonesia, for whatever other reason, also do not recover as quickly as we're expecting, that's another risk that we're seeing here.